Hi, this is Trevor Crow from BizTaxBuzz.com, and this video comes from a blog post I wrote titled Compensating Employees with Equity. In this post, I used a factual scenario as an example. Alex has been the top salesman at Big Widgets Inc. for the past 3 years. The two founders of Big Widgets, Barb and Cole, want to reward Alex and give him an incentive to continue working, so they decide to issue Alex shares in the company. Alex is grateful for his new ownership interest, and Barb and Cole are excited about Alex's future contributions to the company. Everyone's happy, right? Well, maybe not. Alex was happy until his accountant told him he has to pay tax on the value of the shares he received. Alex says, "That can't be right, because I haven't realized any gain." Alex receives stock in a company that he can't sell or use to pay his taxes, yet he has income equal to the value of the stock. In other words, he has a tax bill but no money to pay the tax. For tax purposes, the issuance of equity to an employee is treated as if two steps occurred. The employer paid cash to the employee, and two, the employee used the cash to buy the equity from the company. Accordingly, the cash payment from the employer to the employee is treated as compensation and taxed at ordinary income rates, and the employer is entitled to a tax deduction for this amount. The general rule that an employee is taxed on compensation applies regardless of whether the compensation is in the form of a paycheck or equity. Many employees have the misconception that this equity award is a non-taxable gift. Unfortunately, the tax code does not allow an employer to make gifts to employees. The IRS calls this compensation. Is there a way to structure this transaction for a different result? There are a few possible choices that defer the tax owed over multiple years, such as restricted stock, stock options, but every choice has advantages and disadvantages. The following is an explanation of a few alternatives. So we have, like I said, options, restricted stocks, cash instead of stock, or profits interest if it's an LLC. Let's start with options. There are many rules surrounding the issuance of stock options that are outside the scope of this article, but many companies issue options that meet certain requirements called incentive stock options, or ISOs. Assume that the company issues 1,000 incentive stock options to Alex with an exercise price of $1 each. Here, there is no income tax upon the grant of the ISO to Alex, and no tax when Alex exercises the ISO. Alex is only taxed when he sells the stock in the future on the amount that his sales price exceeds the exercise price. The downside of this alternative is that Alex has to pay $1,000 to exercise his option. Restricted stock. The company could issue shares to Alex subject to a vesting schedule over 3 years, with a third of the shares vesting each year as long as Alex remains employed by the company. Here, Alex would pay tax on 1/3 of the value of the shares each year as they vest. The potential problem with this arrangement is that Alex pays tax on the value of the equity when it vests at ordinary income rates. Thus, if the stock appreciates between the grant date and when it vests, Alex pays ordinary income rates on the full value, including this appreciation. Another option is giving cash instead of stock. So this would be a simple solution for the company just to pay the equivalent value of shares in cash compensation to Alex. Alex would still pay tax on this amount, but he would have the cash to pay the tax bill when it comes due. However, this arrangement defeats the purpose of granting equity compensation. That is, with cash compensation, the company must use cash instead of using its shares, and so that's taking money out of its bank. And also, Alex has no ownership to incentivize him to perform and remain employed with the company. Another option, if the company is an LLC, is a profits interest. When a company is an LLC instead of a corporation, it may grant this option here, which is called a profits interest. A profits interest is one that grants ownership in any increase in value of the company, but not in the ownership of the current value of the company. A profits interest is not taxable upon grant. The owner of a profits interest is taxed when and if the company allocates income to the member in the future. So the bottom line is, an employee or potential employee should understand the tax consequences of receiving equity compensation before agreeing to a particular arrangement. Otherwise, the employee may get more than he or she bargained for when it comes time to pay taxes. Thank you for listening, and I'll see you on the next video.